Hello everyone, this is ACCA Amit Kumar and we'll discuss about financial instruments. This is considered one of the most complex topics under IFRS or Ind AS. We'll try to simplify it. Let's have a look at it. What is a financial instrument? So if I talk about a financial instrument, it is an asset of one entity and a liability of another entity. So unless there is a contract which evidences an asset of one entity and liability of another, it is not a financial instrument. So there is a confusion whether deferred taxes or the tax payable to taxable authorities is a financial instrument or not. Now this is not a contract. We are liable to pay tax. We are bound to pay tax. So it forms part of our liability. It doesn't come under the purview of a financial instrument. In similar fashion, if there is any prepaid expense, we have prepaid it. We cannot demand back the money. We'll only be able to receive goods or services against those prepaid expenses which we have paid. So there is no contract which determines that it is an asset of one entity and liability of another. The only way to receive back the money is to receive goods or services for which we have prepaid this amount. So this results in an asset of one entity and liability of another entity. It's a contract which gives rise to a financial asset of one entity and a financial liability or equity instrument of another entity. Financial asset or financial liability means it is determined in monetary terms. If we look at the items of balance sheet, intangible asset, it is not a financial instrument because it is an asset of one entity but doesn't give rise to a financial liability of another entity. And these are non-monetary items: PPE, investment property, prepayment of goods, deferred income. The deferred income is the amount received in advance. We have not recognized it as part of our revenue since we have not earned it yet. So we will not be paying back the money, we'll be providing goods or services. Current and deferred taxes, as I said, it's an arrangement with the tax authority. We're liable to pay that amount. We have no choice whether to defer this payment. We'll be legally liable to pay this amount. Inventories form part of our assets. We realize this by selling them or any work in progress. So these items doesn't give rise to asset of one entity and a liability of another. So if I talk about a financial asset, cash is a financial instrument. You must have seen the amount written on the 100 rupee note or 500 rupee note, and it also mentions that the government is liable to pay you an amount equivalent to a sum of 100 rupees or 500 rupees. If you noticed, at the time of demonetization, the old notes were replaced with a new one because the government was liable to pay you that amount. It was a legally enforceable right. You owned that right to receive back a value worth 500 rupee. An equity instrument of another entity. So if you're holding an investment in another entity, it forms part of your financial assets measured at fair value. It is a contractual right to receive cash or other financial asset. You receive cash, or in exchange of that loan you have extended to another party, you may receive another financial instrument. The example is a trade receivable or a loan receivable. You receive cash against it, or you can exchange these financial assets or financial liabilities with another entity under conditions that are potentially favorable to the entity. So in case of a financial asset, the conditions should be potentially favorable for us, then only we'll exercise a purchase option. So if we have purchased options, we will exercise them only when it gives rise to a potential favorable situation for us. A contract that may be settled in entity's own equity instruments and is a non-derivative for which entity is or may be obliged to receive variable number of entities' own equity instrument. Now, if you have extended a loan to someone and instead of receiving cash, you may buy back your own shares if that other party is holding your shares. So instead of receiving back the money, you may be entitled to receive your own equity instrument against the loan you have extended to other party. Equity instruments receivable against loan receivable. The number of shares received are variable depending on the price of the share, because you will be receiving back the number of shares on the basis of the amount you are eligible to receive. The price may be variable in the market. Or a derivative that will or may be settled other than by exchange of fixed amount of cash or other financial asset for a fixed number of entities' own equity instrument. It may be decided that the entity will buy back a fixed number of shares. So for every rupee 500 receivable, one share will be received. So if there is a total receivable of 500,000, 1,000 shares will be received or bought back by the company. These are examples of financial instruments: investment in other entities, trade receivables, cash and cash equivalent, interest in subsidiaries, joint ventures, associates, finance lease receivables, interest in subsidiaries, joint ventures, associates accounted for under IFRS 9, that is financial instruments, or derivative financial instruments. These are all considered to be financial instruments, but they may not be covered under IFRS 9 because they may be accounted for by different standard. Like investment in associates is accounted for under IAS 28, investment in subsidiaries is accounted for under IFRS 10 consolidated financial statements. But if they are accounted for in their standalone financial statements on the basis of IFRS 9, then this standard is applicable to them. Financial liability is opposite of financial asset, that now there is an obligation to deliver. We are liable to pay an amount either in the form of cash or either by issuing shares. So if we will deliver cash or other financial asset, the examples are trade payables or loan payables, we are required to settle these amounts. Or exchange financial assets or financial liabilities, that instead of paying cash, we may give away our financial assets. Or financial liabilities with another entity under conditions that are potentially unfavorable to us. Since this is a financial liability now, we cannot decide it. The other party can decide it, and the condition will be potentially unfavorable to us because we are liable to pay this amount. The examples are written options. It may also happen that the contract may be settled in entity's own equity instruments and is a non-derivative for which the entity is or may be obliged to deliver variable number of entities' own equity instruments. They may be required to issue the shares which may be variable in number against the liability. For example, there is a payable of 500,000. So the number of shares issued will depend on the market price of the share in the market. So number of shares issued will be variable. Or it will be a derivative that will or may be settled other than by exchange of fixed amount of cash or other financial asset for a fixed number of entities' own equity instruments. So it may be decided that for every rupee 500 payable, we'll issue one share. So it may be dependent on the total amount which we are required to settle. So for a total payable of 500,000, a total number of 1,000 shares will be issued. So this is how we'll be treating financial assets and financial liabilities. Now, equity instrument is the residual interest in the entity. Now, the difference between a financial liability and equity is a financial liability we are obligated to pay. Equity we are not obligated to pay. We will receive cash for issuing shares, but we are not obligated to pay that amount. So an instrument is an equity instrument if and only if both the conditions mentioned below are met. There is no contractual obligation to deliver cash or other financial asset or exchange financial assets or financial liabilities with another entity under conditions that are potentially unfavorable to the entity, that we are no more obligated to pay back anything. We are not liable to pay or deliver cash. We will not pay back anything to the counterparty. The risk of owning equity instrument rests with the owners of the entity, that is shareholders. A contract that may be settled in entity's own equity instruments and is a non-derivative for which entity is or may be obliged to deliver fixed number of entities' own equity instruments, or a derivative that will or may be settled by exchange of fixed amount of cash or other amount for a fixed number of entities' own equity instrument. Now, when it is a fixed to fixed criteria, that the number is fixed or the amount is fixed, fixed number of shares are supposed to be issued, there is no variability in terms of payment, it can be considered an equity instrument because the amount to be delivered is fixed for a fixed number of shares for a fixed amount. Difference between equity and liability, as we've already discussed: liability we are obligated to pay, equity we are no more obligated to pay. If you look at these examples, A Limited has issued 10% mandatorily redeemable preference shares. Now these are required to be redeemed. There is an obligation to pay back. If there is an obligation to pay back, it will be considered as part of liability. X Limited has issued 10% non-redeemable preference shares. Now there is no obligation to pay back these preference shares, so this component will be considered as part of equity, but there is a mandatory fixed dividend to be paid. This fixed dividend will be considered as part of liabilities. M Limited has issued deep discount bonds. Now these deep discount bonds form part of liability. They will be recorded as part of liability because we are liable to pay back. Y Limited issued non-redeemable preference shares with dividend payment linked to ordinary shares. Now the amount is non-redeemable, even the amount of dividend is also linked to the performance on the basis of shares. So this will be considered an equity instrument. there is a combination of equity and liability, and this is known as compound financial instruments. It may happen that we may come across a compound financial instrument wherein we have to split it between equity and liability component. Those instruments which have the option to convert into equity instruments at the option of the holder are called compound financial instruments. The option is available to the holders that they can convert it into ordinary shares in future whenever they wish to, whenever it is potentially favorable for them. So compound financial instruments must be split into equity and liability component. The liability element is determined first by fair valuing the cash flows without any option. Now, if the same instrument had been issued at market values, what would have been the proceeds of loan and what would have been the rate applicable? Now, since there is an option attached to it that it can be converted into ordinary shares, the rate of interest is lower than the rate prevalent in the market, which results in making it into a compound financial instrument. It has the attributes of both equity and liability component. So we need to split the equity and liability component, what we are liable to pay, what we are not liable to pay. So what we do, we test it on market terms, whatever proceeds we have received and whatever we are liable to pay over the period of this contract, we discount it to present value on normal market rates and try to know what is the difference of proceeds and what we are liable to pay. The difference amount is equity component, which we are not liable to pay. So let's have a look at this. Help Humans ORG issues 5,000 convertible bonds at the start of 2014. The bonds have a 4-year term and are issued at par with a face value of 2,000 per bond, giving total proceeds of 10 lakhs. So the entity has received in total 10 lakh rupees. Now out of these 10 lakh rupees, how much they are liable to pay back? So we'll see how much they are liable to pay back. They're liable to pay back interest at the rate of 7% annually, and they'll be paying it over a period of 4 years. It has an option to convert it into ordinary shares on maturity. Now when the bond are issued, the prevailing market rate is 10%. Now this entity has received 10 lakhs. They'll be paying back 10 lakhs after 4 years, and they'll be paying back interest at the rate of 7% over a period of 4 years. So the total amount they're going to pay will be 10 lakhs after 4 years, 70,000 every year. Over a period of 4 years, they'll be paying back 2,80,000 over a period of 4 years. So we'll discount it to present value on the basis of prevailing market rates and try to know out of the total proceeds how much they'll be paying back. When we discount it to present value, the 10 lakh which we are liable to pay after 4 years, if we discount it to present value, it turns out to be 6,83,000, and 70,000 which we are liable to pay over a period of 4 years. If we apply the annuity factor for 4-year period, the annuity factor for 4-year period for a constant cash flow over a 4-year period, we can apply annuity factor discounting factor of 4 years, addition of 4 years discounting factor added together makes it an annuity factor. So if we discount it to present value, it turns out to be 2,21,830, and the discounting of 10 lakhs which we are liable to pay after 4 years, it turns out to be 6,83,000. So after the total proceeds received 10 lakhs, we will be paying back in today's terms 9,04,830. So if we compare in today's terms, we have received today 10 lakh, and if in today's terms we compare how much we are liable to pay in today's terms we'll be liable to pay only 9,04,830. So the difference is the equity component. So we'll have to split it into two parts. Equity component will be recognized as 95,170, and the remaining proceeds will be recognized as liability. Treasury shares, if an entity reacquires its own equity instruments, they should be deducted from equity. No gain or loss should be recognized in profit or loss on the purchase, sale, issue or cancellation of these shares. The amount of treasury shares held is disclosed separately as per IAS 1 presentation of financial statements. In the statement of financial position, we'll disclose how many shares we have reacquired, and we'll disclose it in the notes to accounts. So this is about a brief summary of the introduction of financial instruments. Thank you.
Thanks for watching. Do not forget to click the subscribe button and hit the bell icon. Do like, comment and share. See you next time. Subscribe and hit the bell icon.